Ever wondered how the stock market works? Today, we're going to unravel this financial mystery. Imagine the stock market as a bustling marketplace, but instead of vegetables and fruits, it's filled with shares of public companies. These shares represent a slice of ownership in a company, and investors buy them with the hope that the company will grow, increasing the value of their slice. The place where all this buying and selling happens? That's called a stock exchange. Now that we know what the stock market is, let's dive into how it works. Companies are the backbone of the stock market. But how do they fit into the picture? Well, let's dive right in. Companies issue stocks as a way to raise capital. Imagine you're starting a business and you need funds to expand. You could go to a bank for a loan, but that means paying interest and returning the money within a specific time frame. But what if you could get the money without having to pay it back? This is where issuing stocks comes into play. By selling shares of your company, you're essentially selling a piece of your business. These shares represent a claim on part of the company's assets and earnings. So, instead of returning the money to a bank, you share your profits with your shareholders. This is a win-win situation. You get the capital to grow your business, and your shareholders get a piece of your success. Now, companies can be either public or private. Private companies are owned by their founders, management, or a group of private investors. Public companies, on the other hand, have sold a portion of themselves to the public through an initial public offering, or IPO. This means anyone can buy shares and become a part owner of the company. So, what's the takeaway here? Companies are integral to the stock market. They sell stocks to raise money, and investors buy these stocks hoping they'll increase in value. This symbiotic relationship is what keeps the wheels of the stock market turning. But what about investors? What's their role in the stock market? Investors are the lifeblood of the stock market. They are the individuals, corporations, or institutions that purchase shares in a company. When they buy these shares, they essentially own a piece of that company, and in turn, they stand to benefit from the company's success. Now, how do they buy and sell these stocks? Well, investors make these transactions through an intermediary, such as a broker or a financial advisor. These intermediaries have access to the stock exchanges where shares are bought and sold. However, it's not just about buying and selling. There's a whole lot of strategy involved. Investors need to consider when to buy, which stocks to buy, when to sell, and how many shares to trade. These decisions are often guided by an investor's financial goals, risk tolerance, and the current state of the market. This brings us to the concept of supply and demand, a fundamental principle of economics that plays a significant role in the stock market. When the demand for a particular stock is high, but the supply is low, the price of that stock will likely go up. This is because there are more people wanting to buy the stock than there are shares available. On the other hand, if the supply of a stock is high but the demand is low, the price of that stock will likely go down. This constant push and pull between supply and demand is what causes stock prices to fluctuate throughout the trading day. And it's these price changes that investors are looking to capitalize on. By buying low and selling high, investors can make a profit. However, it's important to note that investing in the stock market isn't without risks. Stock prices can be volatile, and investors can lose money. But with careful planning, research, and a bit of patience, investing can also be a way to grow one's wealth over time. By buying and selling stocks, investors contribute to the price changes in the stock market. They play a crucial role in the financial ecosystem, driving economic growth and helping companies raise capital for expansion and innovation. Stock exchanges are like the marketplace of the stock market. But what exactly do they do? Well, let's dive into it. Imagine walking into a bustling marketplace where items are bought and sold. This is akin to what happens on a stock exchange. However, instead of tangible goods, stock exchanges deal in securities, primarily stocks. They act as a meeting place for buyers and sellers, facilitating the exchange of stocks in a regulated and secure environment. So, how does a stock exchange work? Well, it's a bit like an auction house. Buyers offer a bid, which is the highest price they're willing to pay for a stock, and sellers ask for a specific price. When the bid matches the ask, a trade is executed. This process of matching bids and asks is done millions of times a day on exchanges all over the world, and it's how stock prices are determined. But it's not just about buying and selling. Stock exchanges also provide a platform for companies to raise capital through the issuance of new stocks. By listing their stocks on an exchange, companies can attract a larger pool of investors, thereby raising more funds for expansion or other business activities. In addition, Stock exchanges ensure transparency in the market. They require companies to disclose key financial information, making it easier for investors to make informed decisions. This transparency also helps maintain investor confidence in the market, which is crucial for its smooth functioning. Moreover, stock exchanges play a vital role in maintaining economic stability. They provide a snapshot of the country's economic health. For instance, if stock prices are generally rising, it could indicate that the economy is doing well. Conversely, a significant drop in stock prices may signal economic distress. In a nutshell, stock exchanges are the backbone of the stock market, providing a platform for trading, raising capital, ensuring transparency, and reflecting the economic condition of a country. They are the gears that keep the engine of the stock market running smoothly. Stock exchanges provide the platform for investors to trade stocks, and they play a crucial role in determining stock prices. So, the next time you hear about the stock exchange, you'll know exactly what role it plays in the grand scheme of things. You've probably heard of terms like Dow Jones or S&P 500, but what do they mean? Well, these terms are names of stock market indices. A stock market index is a measure of a section of the stock market. It's computed from the prices of selected stocks, often a weighted average. It's a tool used by investors and financial managers to describe the market and to compare the return on specific investments. Imagine an index as a thermometer for the stock market. Just like a thermometer measures temperature, a stock market index measures the overall health and direction of the stock market. It gives a sense of the broader market's behavior, beyond the performance of individual stocks. Now let's talk about some of the most common indices. The Dow Jones Industrial Average, often simply called the Dow, is one of the oldest and most watched indices in the world. It includes 30 of the largest and most influential companies in the United States. Then there's the S&P 500. This index is a broader measure of the U.S. market, comprising 500 of the largest companies listed on the New York Stock Exchange or NASDAQ. Because of its wider scope, some consider it a better representation of the market's overall health than the Dow. And let's not forget the NASDAQ Composite, heavily weighted towards technology companies. It includes all the stocks listed on the NASDAQ Stock Exchange, over 3,000 in total. These indices and others like them provide a snapshot of the market's overall direction. When you hear that the Dow or the S&P 500 is up or down, it gives you an idea of how the market is doing as a whole. So the next time you hear someone mention the Dow Jones or the S&P 500, you'll know they're talking about the overall mood of the market. Remember, the goal isn't to beat the index, but to understand it and use it as a tool to make informed investment decisions. Market indices help us understand the overall direction of the market at a glance. Let's recap what we've learned about the stock market. We kicked off this journey by introducing the very concept of the stock market, a bustling, dynamic marketplace where securities, specifically stocks, are bought and sold. We then dove into the role of companies. These are the entities that issue stocks to raise capital. By selling shares of their business, companies can fund new projects, pay off debt, or expand their operations. But remember, when you buy a stock, you're buying a piece of that company, a stake in their success or failure. Next, we explored the role of investors. That's you and me. We buy these stocks, these slices of companies, in the hope that the company will do well and the price of the stock will increase. But it's not just about making a quick buck. Long-term investing can provide a steady income stream through dividends and can even help us save for retirement. Then, we turned our attention to the role of the stock exchanges. These are the platforms where the buying and selling of stocks take place. Think of them like a farmer's market, but instead of fresh produce, it's stocks that are up for grabs. Some of the most well-known stock exchanges include the New York Stock Exchange and the NASDAQ. Finally, we delved into understanding stock market indicators. These are like the vital signs for the market, showing us its health and giving us clues about potential trends. We looked at key indicators like the Dow Jones, the S&P 500, and the NASDAQ Composite, each offering a unique snapshot of the market's performance. It's been quite a journey, hasn't it? But remember, this is just the tip of the iceberg. The stock market is a complex and ever-evolving entity. So keep learning, keep exploring, and most importantly, keep asking questions. Now you have a basic understanding of how the stock market works. Remember, investing in the stock market requires careful research and consideration. Always make informed decisions.